Well, we've looked at some details now for life insurance. Let's look at some details on annuity because those are the two primary products you're concerned with in an investment-related context. Remember, with an annuity, you pay one initial premium and then you receive back. Now, there are variations on annuities. You can do what are called finite annuities. You can receive payments for 20 years. That's generally not going to interest us because you could outlive the payment stream. We're usually looking at lifetime annuities. You can't outlive it. As long as the annuitant is alive, the payments continue. Now, you can do other variations. Let's say we have a couple. You could do joint life annuity. As long as either member of the couple is alive, the payments will continue. Now, one of the sort of knocks against lifetime annuity is, well, what if we die tomorrow? Nothing would be paid back. You don't get your premium back, just everything ceases. The insurance company keeps it all. So you could write in, it is for life, but at least 10 payments or 20 payments will be made. If you die early, your designated beneficiary would receive those subsequent payments. That's a certain number of periods. Sounds good, but remember, the insurance company will charge more for that because in aggregate, it means they're going to have to pay out. So we're mainly focused on lifetime annuities. But another key decision is fixed versus variable. We're going to look at that. We're also going to look at, do you want the payments to start immediately on the annuity, or do you want to delay the start of the payment? So we'll look at some important variations on lifetime annuities. Let's think about the cost of an annuity. Let's say the initial premium is $100,000. We made it GBP. These don't have to be in the United States. There's an annual annuity payment of $5,000 for life, with a minimum of 10 payments. Even if you die before that, at least 10 payments will have been made to you, the annuitant, or the designated beneficiaries. There's another annuity with all else the same, but the payout is only $4,700 annual payout. Gee, we paid the same amount of money, everything is identical, except one pays $5,000 a year and one pays $4,700 a year. Which one cost less? Now, I know the initial premium was the same, and I know we call the premium the cost, but in this context, we're saying, what did you pay versus what are you going to receive? For the same initial payment, one of these will pay you more. That's the better deal. That is, quote, the lower cost product. But it was critical that everything was identical except one variable. One of them pays more a year, one of them pays less a year. The better deal, the quote lower cost, is the one that pays you back more. The lower periodic payment is higher cost. $500,000 premium. Here's another example. An annual annuity payout of $20,000 for the joint life of a couple versus a different policy also for joint life paying $21,000 a year. All things the same, receiving $21,000 a year is better deal. The one where you receive only $20,000 is the more expensive product, as it were. So recognize what we mean by cost. We do talk about the premium paid as being the cost, but when they start talking about benefits, if the premium payment is the same but the benefit is different, they don't really have the same cost the way a normal person would look at it. That's the point they wanted to make. Let's talk about now fixed versus variable. And you see I've added some things to make this an example. So we're looking at two annuities. They both cost initially $100,000. The first one pays you $1,000 a month. The second one pays you 0.75% of its value, which is $750 a month. This looks simple, but all else is not the same. The first is what's called a fixed annuity. You will get $1,000 a month for life. The second is what's called variable. You get 0.75% of the value of the annuity per month. Now, the initial investment was $100,000, that's $750,000. But with a variable annuity, the value is usually tied to some kind of an index. Let's say it's a stock index. So over time, the stock index is likely to go up. The designated value of the annuity would be going up, and you'd be getting 0.75% of a rising value. So your payout would go up. So no, we can't say which of these is the better deal because they differ not just in what you pay per month. One of them is a fixed per month. The other one is variable and likely to rise over time. Generally, the assumption would be the variable also probably includes some extra features, like a cash payout. Typically, when you buy a fixed annuity, you paid the money. That's the end of the deal. You keep getting your payments. That's it. But variable annuities might include a provision that if you want to, you could close the annuity early and receive back some of its value. Now, the value you would receive back would be tied to that underlying index, so we can't say exactly how much you'll get, but the possibility of redeeming early is more likely. Different kinds of features are also included. The general bottom line is the variable is putting more risk on the annuitant. The annuitant is not as certain what they're going to get each period. And it's tied to a risky asset, but risky assets tend to have higher rates of return. So the general assumption is over the life of the annuity, variables probably provide a better payout, but they're transferring more risk to the annuity, less certainty. The fixed is easy to understand. We know exactly what we're going to get. That's less risk. The return is probably lower, but things are more certain. So that's a trade-off you've seen before. The fixed policy is also very much tied to interest rates. Think about it. The insurance company receives your premium once initially, has to invest it to pay for your remaining life. Well, they're probably going to look at the bond market. What rate of return can they get when they initially receive the premium? So if you buy a fixed annuity when interest rates are low, the annuity payment to you is probably going to be low. If you buy a fixed annuity when interest rates are high, the payout is likely to be higher. So the initial level of interest rates is probably going to have a significant effect on the payment you would receive on a fixed annuity. With the variable, what you will get in the future depends on future rates of return. Again, those are usually tied to the stock market. There's uncertainty. You're taking more risk as the annuity, so their lifetime payout is generally expected to be somewhat higher. And as we pointed out, the variable also might let you redeem it early, albeit at an unknown future value. Fixed, they don't normally have that type of provision. Let's take a look at another issue. When I buy the annuity, do I want the payments to start immediately, or do I want them to wait before they start? Now, you might say, I want the money now. But remember, if you take the money now, they won't give you as much. If you wait, they'll make the payment bigger. Now, a particular iteration of that is what's called an advanced life. So we're going to make the delay period very long. And we're going to see why this is logical. Suppose we have a client, Jane. She's 60 years old. We've advised her to buy a $500,000 annuity. In other words, pay $500,000. The annual payment to be received back is $95,000 a year. That looks really good, but look at the fine print. Those payouts will not start until Jane is 85 years old. That's 25 years from now. Now think about a normal situation. We have a client, they retire, they're worried about outliving their assets. As long as they don't live too long, everything's going to be fine. But under extreme conditions, they might outlive their assets. Well, here's the perfect hedge against that risk. We buy this policy, we pay for it, Probably we're going to die before age 85 and get nothing, but in the event we do live a long time, that $95,000 a year will look really good at that point in time. So these are an ideal mechanism to insure against extreme longevity risk. And the insurance company is not going to charge you very much in relation to that annual payout quote, for a couple of reasons. Mortality estimates. A lot of individuals will die before they collect anything. So the company doesn't have to charge very much on these policies. The people who do live to age 85, they're probably not going to live a long time after that, so the number of payouts the company will have to make will be fairly low on these advanced life products. In addition, they have that premium for a large number of years and they can invest and start earning immediately. So the initial cost of this kind of a product will be very low compared to an annuity that paid you $95,000 a year starting right now. The cost will be much, much lower. A good vehicle to hedge against extreme longevity risk. This is introducing something we want to now label, a mortality credit. And it's critical to understanding how insurance products work. An insurance company is selling you a product, but they're not pricing that product only. They're pricing an aggregate book of business where they're sold to a large number of individuals. And they're playing the law of averages. On average, what will they pay out? And on average, when will they pay it? Now that's also important because on average is a lot more predictable than trying to say what will happen to one individual. So while one individual's death is not very certain, in aggregate, insurance business is relatively certain, and the companies certainly know how to do the math extremely well. I don't know if any of you happen to also be actuaries. The mathematical training for an actuary, boy, they laugh at the stuff that's in the CFA program. Their math is far beyond any of the kinds of things you deal with. Their concept of time value of money go well beyond what you're responsible for. They know what they're doing when they price these products. Now, to illustrate this, let's take two individuals, Sally and Jane. And everything we look at about them is, they are statistically the same age, same health, same situation. Statistically, they're not different. They both buy one of these deferred annuities. They both pay the $500,000 up front. Remember, this annuity is not going to pay unless they reach age 85. And they're identical. They're both 60 right now. Now, let's suppose Jane dies at 84. Boy, she's not going to collect anything. She didn't make it to 85. Let's suppose Sally lives to 105. She'll get 20 annual payments. They both paid the same money up front. One of them gets nothing back. One of them gets 20 large payments back. So Sally has benefited by Jane's early death. Now that's a little bit morbid, so we label that a mortality credit. Sally is benefiting in this case by living a long time, and Jane is suffering by not living as long in a financial sense. So the concept of mortality credit is this law of averages. It's inherent in the way insurance companies price their product. And it's a key factor. And it's also getting at how you're sharing risk. Some people live a short time, some people live a longer time, even though they started out statistically identical. And by insuring a large number of individuals, the company can be pretty sure what's going to happen. They're avoiding adverse selection. They're diversifying date of death risk is what's really happening. Now, what about when should I buy the annuity? Should I buy it right away, or should I wait until I get older? Maybe I can keep and use the money for a period of time. So let's illustrate the issues that go with that, again, with an example. We got a 55-year-old investor. They are thinking about spending $750,000 on a fixed annuity. The payouts start in 5 years. So it is a deferred annuity, not an extreme deferral, a deferral in this case of 5 years. Now they have a choice. They could go ahead and purchase now. And they find the quote is they would receive $80,000 as the annual payout starting in 5 years. But they have an alternative. They don't want the payouts to start for 5 years. Why don't they just wait? And they buy the annuity 5 years from now. They could keep the money on hand, they could invest it, they could earn something on the $750,000 for the next 5 years. Then they buy the annuity for immediate payouts because that's when they want the payouts to actually start. It's one individual. Their life expectancy is their life expectancy starting at age 60. So the total number of expected payouts would be the same for A or B. Now, they also expect interest rates to be going up. If interest rates are going up, that favors wait to buy the policy. Because on a normal fixed annuity, the level of initial interest rates has a significant effect on the pricing. Interest rates are going to be higher in 5 years. It is likely insurance companies will make higher payouts on policies starting in 5 years than they do today when interest rates are lower. That would favor waiting if that's our expectation. But that's also superficial. It's not considering time value of money, and it's also not considering mortality credits. So let's dig into this a little bit more. What would favor alternative A? Go ahead and buy now. Well, if the company gets the premium now, can put it to work for 5 years before they start making payouts, remember, it is still a 5-year deferred annuity, that means they can offer you a higher promised payout. So it wouldn't be the same as just waiting. Let's go ahead and give them the money. They can put it to work. Therefore, they'll give me a better deal on the initial contract. We also, though, have to think about the mortality credit. If we buy it now and we stay healthy and are still alive, we're going to be collecting starting at age 60. But some of the people who buy these policies now won't make it to age 60. They will die prematurely. The company will have taken that into account. We will be earning a mortality credit, and it would be reflected today in what our promised payout is going to be. So the company's ability to use the money now, and the fact that by going ahead and buying and locking in the deal, we are earning a mortality credit, they both favor let's go ahead and buy the 5-year deferred annuity today. What favors alternative B? Hold on to our money, take our chances, buy something 5 years from now. Our interest rate forecast favors alternative B. Because if interest rates are higher in the future, that should argue for better payout deals on annuities 5 years from now than today. The purpose of this is not to say which is the better deal. The purpose is to understand what are the arguments for A, what are the arguments for B. And that's as far as you're going to have to go. You should be able to realize that, yes, if I'm really good with math, if I want to quantify everything very precisely, of course you can build time value of money models to analyze further, but that's beyond the scope of your assignment. You're just getting the building blocks that the issue is not simple, and the ultimate answer depends on, well, what assumptions you're going to make. Some things favor this, some that. If you quantified enough, you could make an estimate, but it's only as good as your assumptions. Understand the drivers is your task. You know, there is another alternative. Don't buy an annuity. Keep your money, invest it, earn an annual return, start to draw your portfolio down, and let's hope we don't live too long. The insurance companies do not invest aggressively. Their rate of return, you could probably generate a better rate of return yourself than the insurance company can do. And we'll see that in the next study session as we dig into how insurance company portfolios are managed. They don't earn particularly high rates of return. That's not their big incentive. So you might do better. And you can start withdrawing your principal. Ultimately, they're just giving the annuitants back their own money and whatever the insurance company has earned. So this is equal whether you self-insure or you give it to the insurance company in aggregate. This would actually favor keeping the money. That's called self-insurance. But there's a huge risk in that. You may be the individual that lives a very, very long time and outlives your assets. Other annuitants may die early and things just stop. So if you buy the insurance product, the annuity, and you do happen to live a long time, you're earning the mortality credit. You're getting the money from the people who died prematurely, and the insurance can provide that. Investing your own money cannot provide that. What favors the annuity instead of self-insurance? Now, we can, of course, build big, elaborate models. That's not where they're going to go. They want to make it more basic. If you have a much longer than expected average life, you should probably buy the annuity. You can't outlive it. By the way, make sure you use a reputable company that won't go bankrupt, because you do want to make sure they can pay you. If you're very adverse to risk, an annuity is a low-risk thing. It's protecting you. It's not a high-return product. It's a risk reduction product. If you're very worried about risk, annuity makes sense. And make sure you do lifetime annuity. What if I don't care about leaving anything afterwards? Put all your money in an annuity. It's all gone when you die, but you're taken care of. You don't care if there's an estate left for others. If you have no other lifetime income streams, what if you don't have a pension? What if your country doesn't have a Social Security type set of payments, or you don't think it's going to continue on? Well, you're at risk. You don't have anything else that'll last for a lifetime. You may have more reason to want to buy an annuity with at least some of your money for protection, for risk reduction. And those are good practical considerations.